Hey credit warriors, Credit Shifter here, and today we are going to be looking at how to prepare for a mortgage application. Sorry about the weird background, I'm at home, not at the office, so this is what you get. First of all, this is not going to be a comprehensive guide. I'm just going to go through what I think are some of the main points, but I encourage you to watch other YouTube videos on the same subject. Go and read books and stuff. But anyway, let's go through what I think are the key points of this. So first of all, you need to know how much income you have to work with when you go and apply for a mortgage, okay? And we're going to show you how the mortgage originator, the mortgage broker, will be determining your income. So if you are employed, i.e. you get a W-2 form from your employer, your taxes taken out, you normally only need to provide 1 year's tax return, okay, to prove your income. If you run your own business, like an LLC or other kinds of self-employed, then you need to provide 2 years of tax returns, okay, to prove your income. The income on your tax returns that can be counted as well is only income from jobs that you still have. So in my situation, I run my own business. I did have a full-time job that appears on my last year's tax return, but only for the first few months, but it does boost my income by several thousand, or even 10,000 or something, and I can't use it, okay? I cannot use that income, so that actually brings my income down significantly in terms of what can be used for a mortgage application. So just be aware of that. If you have set up, say you've set up your own business, your income, and you've kind of transitioned from being in a full-time job to running your own business, the income from the job you used to have can't be counted. And because of that, you may need to wait an extra year and get your following tax return the year after, so you can show higher income from your business. But anyway, that's basically the rule. If you are employed by a company, it's 1 year's tax returns. If you are self-employed, it's 2 years of tax returns. So once you've decided that you have, adequate proof of income, you then need to really ask yourself whether your income is enough for what you want to get. And so you need to look at your debt to income ratio, and this is going to include what you would be paying in debt if you had a mortgage, which includes the mortgage payment and all the, the private mortgage insurance if you have it, the property taxes, on top of debts you already have, such as your, if you have a student loan, if you have a car loan, or even like things like child support, if you are paying child support, and other payments can be counted into this. There's quite a few things. Now, most lenders do not want a debt to income ratio that's above 43%. So that's 43% of your monthly gross income. Gross income means income before taxes. Okay, so a little bit higher than what you may actually receive after taxes are taken out. But anyway, in general, can't go above 43%. That's generally, that's certainly for FHA loans, that's their policy. Most lenders, that's their policy. Some will go above for 43%. I've heard 48, I've even heard 55, but many of these, there'll be conditions with it, like they'll only go that high if they observe rising income, for example, projected profits from next year. For example, if you run your own business, are going to be higher, or maybe you show profit and loss statement for the first 6 months of this year that's higher than half of your income last year, and so your projected income is high, whatever. But in general, it's 43%. And also, if you are using, more than 43% of your gross income, you're not going to have much money left to live on. So I would even want to go below 43%, even be like, 30% to have a more comfortable life. You don't want to be spending so much money on housing payments anyway. Looking at this debt to income ratio is going to tell you what kind of a house you can actually afford. So let's just give an example. If you earn $6,000 a month, you already pay, say $1,000 in debt payments each month, and then the house that you want is going to result in a monthly payment of $2,000. Your mortgage payment, property taxes, and private mortgage insurance, if you have it, all those things are going to be $2,000 a month. That's going to take you to $3,000, which is 50% of your gross monthly income, and that's too high. That's above the 43%. So you wouldn't be able to buy a house in that price range. You'd have to go to a lower price range, and maybe you don't want that, so you might want to wait, increase your income a bit or whatever over the next year or so. So as long as it's below 43%, you will be able to buy the house in the price range that you want. You'll be able to get approved for the mortgage in the price range that you want. Okay, let's now get into looking at credit score and credit reports and what rates certain credit scores will get you, because this is another important factor in that, if you get a bad interest rate, then that could result in a higher monthly payment, which could push you over that 43% of debt to income ratio, and then you wouldn't be able to afford the house that you want anyway. So with credit scores, there are actually tiers of credit scores that will determine what interest rates you get. In general, above 740 is like top tier. You're going to get the best interest rates. Some mortgage lenders will want to see 760, but in general, it is 740 you'll get the best rates, okay? Now, below 740, if you're still above 700, so from 700 to 739, that's considered like tier 2, you'll kind of get the second best rates. Then you've got another couple of tiers from 660 to 799. That's normally broken into two 20-point tiers, which the interest rate will get progressively lower. And if you are below 660 on your credit score, you're considered subprime. So you guys have probably heard of the subprime mortgage crisis of 2008. That was when, you know, banks were issuing mortgages like really easily. There were a lot of loans to people with low credit scores. You know, lenders were liking it because they were getting high interest rates, so a big return on their investment, right? Because these people were paying real high interest rates because they were subprime, but it's very risky, and a lot of people started defaulting on their mortgages, and the banks were foreclosing on them, and it led to a huge crisis to just burst and everything collapsed, okay? So that's subprime, all right? Now, back to what we're talking about. So basically, if you're below 660, you're going to be getting a sky-high interest rate. If you're below 640, you probably won't even get a mortgage with most lenders. Even FHA is going to be difficult. So FHA is the Federal Housing Authority. It's a certain type of mortgage that's insured like by the government, by the FHA. Now officially, FHA loans you can get with a credit score of 500 or higher. The only official stipulation from the FHA is that if you're under 580, you have to put 10% down as a down payment, and if you're above 580, you only have to put 3.5% down. And no matter what, you have to buy private mortgage insurance. In general, a down payment below 20%, you have to buy mortgage insurance, even if it's a conventional loan. But in practice, with an FHA loan, there aren't many lenders who are going to give you a loan anyway if you're under 640. You know, some will, but the interest rate may be sky high because lenders can set their own requirements in addition to the government requirements for it. So what do we take away from all of this? Well, we need to get our credit score above 740, basically. If that's not possible, we need to get our credit score as high as possible before we apply, or to a height that we are satisfied with. The differences in interest rate could result in, let's just use the example, because you're in a lower tier, your mortgage is now $50 more expensive per month. Now, over 30 years, that adds up to $18,000. So it really is a huge amount of money over the lifetime of the loan. So it really is in your interest to try and get the lowest interest rate possible. So we need to make sure we have the highest credit score possible, and to do that, we need to look at our credit score and credit report. So I would suggest that starting at least 6 months before you plan to apply for your mortgage, and even longer before, if you know that you have bad things on your credit report, you need to start looking at credit reports and credit scores. So first of all, you can take a look at annualcreditreport.com, which gives you free credit reports from the 3 credit bureaus, okay? And you could do this before 6 months. You know, you could do this anytime, basically. You should do this once a year anyway. And you just look for negative information. It doesn't give you a credit score, by the way. It just gives you a report. You can see hard pulls, you can see any collections, any mispayments, you know, anything like that. And if you have bad information, like you have mispayments, like you have collections or whatever, you need to go through a credit repair process to fix it. And a lot of this information can be fixed. Now, this isn't a credit repair video, so I'm gonna not talk about this part in much detail at all. There's a lot of other videos and other YouTubers, there's books. I may do some videos about it in the future. If people are interested in that, please comment below. Now we've had a look at our credit report. Let's say our credit report is fine, all right? We haven't got much negative information on there. We then need to get our real credit score. Now the credit score on, say, websites like Credit Karma, that is really just an educational score only, okay? It's good for, you know, as a guide for applying for credit cards, which are the least strict in terms of their, you know, the algorithm and everything for the application. But once you're applying for car loans, mortgages, etc., you need a more accurate credit score that uses a more strict algorithm, okay? So you can look at that as a guide, and I'll give you an example. My credit score from Credit Karma is a 770, all right? Now, I have here a report from a mortgage broker that gives me an average credit score between the 3 bureaus of 730. So that is a huge difference. It's a 40-point difference because the algorithm used for working out a credit score for a mortgage application is the most strict out of any of the credit scoring algorithms. You got mortgage, car loan, student loan, credit card, whatever, okay? So that's a huge difference. So you need to know your real credit score, and I would say know your real credit score about 6 months before you're going to apply for the mortgage. The reason is, once a lender checks your credit for a mortgage application, they are locked into using that score for 90 days. Okay, so let's say your score comes at 739 and you want to be 740 or above to get the good rates. Well, that is set in stone. So if you're at 739, you're not going to get the 740 credit score rates. And once they've checked your score, they're locked using that score for 90 days. So you can't just be like, oh, I've got high balances, I'll lower my utilization, then probably next month my credit score will have improved by a couple of points, I'll be over 740. That's not going to happen because they're locked for 90 days. So you need to know your real credit score before you do the application. And there's basically two ways you can do this. One way is using myfico.com. You pay $60 for this report here, the one that gives you all three bureaus. If you want just one bureau, it's $19.99 or something, but you need all three. So it's $60 and you get all three. And you get different credit scores for different things, and you need to look at the one that's for a mortgage because that's the most strict and what you're actually going to be applying for. Another way you can do this is just befriending a mortgage broker or someone who works in a bank who is able to pull credit reports, and you just ask them to pull you a credit report that would be used for a mortgage. And that's kind of what I did. It's not so much a friend, but I just got in contact with the mortgage broker and said, yeah, I'm thinking of applying. Can you run my credit and, look at my income now and then just tell me what I would get if I apply now? I may end up waiting and applying in 6 months or so, but I'd like to just know what I would get. And so, yeah, they ran my credit and they sent me this report, which includes credit scores from all three bureaus. You can see with Experian, I'm 730. With TransUnion, I'm 727. And with Equifax, I'm 733. And what they do is they take the middle score. So I came out at 730. So I'm actually 10 marks below that 740. So I'm all good. I'm not going to apply right now. I'm going to wait 6 months. I'm gonna, make sure I pay my balance down before my due date so it doesn't report balances, because that could be one of the reasons. Also, another interesting thing the mortgage broker told me was that with charge cards, so Amex charge cards like the Amex Platinum, etc., because they show up not as revolving credit accounts, but open credit accounts, they have to pay it in full every month. They can look to the lender like you have to pay that amount every month. Okay, similar to like an electricity bill or whatever, like it's a debt that you have to pay every month. And so you want to zero those out before you apply so as not to confuse that lender and make them think that you actually have some debt that you pay every month, and then that will distort your debt to income ratio and possibly make you not able to get the house that you want, or you'd have to go and explain this to the mortgage broker that it is a charge card, etc. Credit cards, also you should keep your utilization really low so as not to negatively impact your credit score when it's checked below 10% or whatever, so you can get the maximum credit score. So you check your credit score 6 months out. If you're over 740 or at least in the range that you're satisfied with, and your debt to income ratio is below 43%, you can then think about going ahead and applying for the mortgage, and you should be able to get the mortgage for the property in the price range that you are looking for. Okay guys, that's the video for today. There's so much that you can talk about with this. And remember, this is just for educational purposes. I'm sharing with you the experience I've been going through over the last few months, because I am thinking of buying a house probably in January or February time. Also, pro tip that in the winter, less people buy houses. So the, depending on the area, the price can be significantly lower, up to 10% maybe. And there's also less competition. And that's the reason the price is lower, because you don't get involved so much in bidding wars. Many people, especially families with kids, want to move in the summer so they can get their kids into the school before September, before school starts, so they are settled in their new home, new area before school starts. So there's less people moving in the winter. So that's just a little pro tip for you guys. That's why I'm thinking of buying in January, February time. And I just had my credit checked now using that method. I didn't buy the MyFICO thing. I got a report from a mortgage broker, and hopefully I can get my credit up 10 points. What you can remember, guys, as well, is that it's a negotiation. So when they tell you an interest rate, you can always negotiate it and try and get it lower. And you can also shop around. don't be afraid of having your credit pulled by multiple mortgage brokers. If it's within a short period of time, it's built into the system to show that, it'll just show up as one hard pull because they know that you are shopping around for rates. You won't be penalized for that. All right, guys, so that is the video. I hope that helps. Don't forget, if when you're making financial decisions, the advice of a professional is always better. This is more of an educational experience to share with you my story of what I'm doing. Please subscribe if you are new. Leave your comments about applying for mortgages, loans, all that kind of stuff. And we'll see you next time. Bye-bye.